Money, bang in there, 10 billion Swiss francs. You're at the upper end of the range. Assets under management up. It looks as if the first half of the year has been good to JB.
Look, absolutely, we're thrilled with the results. I think is our best half year ever. Net new money is very strong, even above our target range. It has exceeded our expectation, and I think that's on the back of very good momentum on hiring last year. So all lights on green.
All lights on green. I suppose the question then will be, from the market, is A, is that sustainable from the geographies that you got it from? And B, you balance it out and you say, look, trading income is down. So talk me through the balance. First of all, sustainability. And secondly, that appetite from the clients. Trading is down by 23%.
Look, I think if I look at net new money, momentum should be maintained. Obviously, we're going to be continuing to navigate in our target range. We're not going to come out now and say, okay, we have a new target range. We've always said in good times and in bad times we would deliver this 4 to 6%. I have every indication right now that the environment should continue to be positive on net new money. Trading, clients have been back. They're back in the market. I think what we're hearing out there, be it from central banks, be it from IMF this morning, bodes well for private banking client activities. So I think we should also in the second half see clients in the market. Do you think we're going to get, is there a bit of an indication out there that clients are getting ready for more volatility? Absolutely. Volatility has been historically too low. People were worried for a while about the fact that volatility wasn't there. But I think this is just one of the many indicators. I think the main one is sentiment, is what's the market sentiment. And everywhere clients are getting positive on average more than what we've ever seen in the past. They're getting more positive, and is that just on the likes of equities? I'm talking about exchange-traded products. Are they looking across the asset classes? Where's the most prevalent interest? Equities, and equities, obviously. Fixed income, they're obviously looking, as you know, positions in fixed income are huge in the market, so people are also sensitive to that. And I think they're looking for performance on the fringes of the market all the way to private equity. Look, has Linda got together with you? I get together with you, and you say to me, man, it has Linda, the holy grail for me is China. I read the news flow this morning. I see a billionaire, bang, out of the traps, Hu Wen Mao coming out. He wants to create a $3 billion wealth management business from zero. Is it getting harder to do the business offshore in China? Give me a sense of what's going on in China in terms of the momentum. I think we're getting to a perfect constellation for wealth management firms to go onshore. And I think local players are also getting that feeling that they need to evolve their model to be competitive. You're having a renminbi that doesn't go in one direction only. Market performance has been patchy over the last 1 to 2 years. People have been invested in relatively illiquid products. So there is a strong need for professional, long-term, diversified wealth management. And there will be lots of local players as well, international players that will want to grab a slice of that. Look, I need to hone you down a little bit because people do want to understand what is the next step for you, whether it is onshore and hiring again. You hired 166 bankers around the world last year. My reading of it is they were senior relationship managers. Is that what I get more of from Boris Collardi's Asia strategy? I think you're going to get from us 3 things. A, continued geographic expansion, and I think we're going more and more regional. So you can expect us to continue expanding in Asia, building on the 2 strong hubs that we have, and maybe adding other centers in future, so going onshore. Second thing, we're going to continue to hire senior professionals. We're, I think, one of the best destinations for top talent in the industry. And thirdly, to continue to look at the market also for inorganic opportunities. Inorganic opportunities, what a wonderful phrase for acquisitions. Yeah. It's still a core, will it be a core part of the strategy to build out? I think it is a core part in the top 3 objective of our strategy, but opportunistic. I talk about wealth management every day. Anna and I spend every morning wealth management products battered in China, PBOC, harrying down wealth management. Tell me what that means. What does that mean? China getting to grips with wealth management. Where's the flow? What are the consequences? What does it mean? You deal with it. I think there are 2 things that are going to happen that we're seeing already happening now. The money that is offshore will stay offshore, will continue to be managed long-term, lower risk. And I think the focus now is going to be onshore to professionalize, to really bring high net worth individual practices to the international standard. So that's where the flow is, and that's where everyone will go in the years to come.
Is there a blowout pop risk in that? Is there a risk in that? Do you see a risk in that?
I see only a risk of the transition going from the current industry, where I think there have been a vast number of players that have offered a lot of products, but I think these products are not up to scratch with what international wealth management should be. So the transition from that set of products into a diversified asset allocation, that has some risks.
But ultimately, that could prove a benefit for you, though, couldn't it? A better regulated industry is something that will play well to your brand.
Absolutely, and I think in China also one of the key products besides diversification will be also multi-generation wealth transfer. I think we're getting to a first wave of entrepreneurs that are passing on wealth and enterprises to the next generation, and that's something that I think we do since several generations.
One last question before we move on the business, which is the cost-to-income ratio. You've already made a statement this morning. Look, I want to do better. The target range is 64 to 68%. You're still just outside that bandwidth. Yeah. What does that mean for a CEO? There's obviously more work to do. How do you get to the bandwidth?
I think we've made already quite a leap from the second half of last year, given the fact that last year we invested quite a lot. We're focusing on two things, improving and deepening the revenue base. Very clearly, and I think we've seen that the growth has not come at the expense of margin in the first half. I think we should be able to expand on that. And secondly, very strict cost control, investment prioritization, investment discipline. So we're confident we're going to get next year into the target range.
Okay, we'll hold you to that. I'll be back next year with my 64 to 68% rule. Now, the last interview you gave was on Brexit, and you said Julius Baer is on pause in regards to building out a hub in the UK. Are you still on pause? Have you changed your mind in regards to the UK as a centre for build-out? The latest on your Brexit discussions?
We're still on the same position, so we're not shifting resources out, maybe unlike some others, but we're also not necessarily making grand plans for expansion other than developing also our same organic growth strategy. The good news for Julius Baer is maybe we've been a bit underinvested in the UK in the past. We still have quite a bit of room to grow in the years to come.
So you would commit more, you'd be prepared to commit more to the UK, even though we don't know the Brexit outcome at this stage?
I think what we're seeing is that there is a gap in the market. There is basically market share to grab from people that are retracting, from people, other firm strategies maybe that are not as focused as they used to be in the past, and we're trying to play that segment.
Give me your global view. We hear Macron offering potentially tax incentives to bankers. Vive la France. We hear every day, we print stories at Bloomberg, bankers moving positions to Frankfurt, prepare for Frankfurt. In your mind's eye, the consequence of movement of jobs, once they go, once a CEO decides to transfer jobs, 250, 300 jobs, from London to Frankfurt, to Dublin, to Paris, how difficult is it to get those jobs back, Boris, when they go?
Frankly, it's nearly impossible. I mean, it will take a decade, if at all, and a perfect constellation for these jobs to move again, because moving jobs is not only about moving physical tasks, it's about moving people, it's about committing investments, it's infrastructure, and I think in any reasonable company, you have to do that over a planning cycle, so I don't think these jobs are going to go back anytime soon.
You must be looking at centres, Frankfurt, Paris, etc. It's part of the consideration for a smart CEO. There is a movement, there's a skew, isn't there, at the moment to Frankfurt? Would Frankfurt work for you? Where does it rate in terms of the top 3 destinations for you, if you have to do something?
I think Frankfurt is, for us today, #1, but will become #2. We've decided to move our hub. We're maybe a bit ahead of the market. We already had our European hub in Frankfurt, but for strategic consideration, we have decided to move it to Luxembourg. And I think Luxembourg and Frankfurt will be the backbone of our strategy, with the third location continuing to be London. You need to keep that optionality.
You mentioned the IMF report, and I just want to get a sense for you. I know your strategy is very Asia geared, China geared, Australasia as a geography. But the IMF has upgraded its European forecast today. That's good news, though, in part for your business and in part for sentiment.
That's excellent news, and we need at any point in time one or the other region of the world to be having a positive momentum. The strengths of our business model is we're in Asia, we're in Europe, we're in Latin America, so we can capture any.
Do you feel the change in Europe? Do you feel and touch the change here?
The mood has gotten better. If you talk to clients, if you talk to investors, definitely the mood has gotten better. Europe is always a little bit slower. Is maybe less fast to react to market sentiment or market changes than Asia is. But I think it's also going to be a longer cycle. So I'm very positive, and I think we can capture that growth in Europe from our historical position of strength.
Just want to touch finally on the currency. Bang, bang, bang. The levels keep going, don't they, for Euro Swiss franc? 110 is gone. Is that good news for you? Do you see that trajectory continuing? And is the SNB behind the curve? I don't want you to get in touch. I don't want you to get in trouble with the regulator. But are they? Is there a risk that they could fall behind the curve?
Look, I think it's good news for our business model. As you know, we have more cost in Swiss francs than in euro, and on the other side, we have more assets in euro than in Swiss francs. So any weakening of the Swiss franc is good news for our overall results. I think the Swiss National Bank is probably looking at the development positively. What it takes beside all the intervention is a positive macro differential, which is starting to happen now. So Europe outlook perspective and then interest policies following, we should see the 110 level to be the new floor.